Welcome to today's What Will Move the Market show. I'm your host Prem. It's Tuesday, February 3rd, 2026, and here is everything you need to know as the markets open for today. Let's start with Wall Street overnight. The US markets closed on a positive note Monday with strong momentum across the board. The Dow Jones Industrial Average climbed 1.05%, adding 515 points to close at 49,407. The S&P 500 rose 0.54%, finishing at 6,976, while the Nasdaq edged up 0.73% to 25,739. The rally was driven by solid earnings beats and resilience in technology stocks, particularly Apple, which surged 4% on record iPhone revenues. Western Digital also jumped nearly 8%, extending January momentum. However, Microsoft faced headwinds, declining on cloud growth concerns despite beating earnings. Overall, the markets are signaling cautious optimism as earnings season progresses and investors digest valuations in the technology space. Now to Indian ADRs, which showed impressive overnight strength. Infosys climbed 4.32% to $18.34. HDFC Bank surged 4.35% to $33.79. ICICI Bank led the pack with a 4.98% jump to $30.75. Reliance Industries moved more modestly, up just 0.16% at $60.8. The strength in Indian ADRs is notable and signals positive sentiment among global Indian investors, likely reflecting optimism around the just-announced US-India trade deal. Speaking of which, this is a major development. President Trump announced an historic trade deal with Prime Minister Modi on Monday. Effective immediately, the US has reduced reciprocal tariffs on Indian goods from 25% down to 18%. In return, India has committed to purchasing over $500 billion worth of American products including energy, technology, agriculture and coal. New Delhi has also pledged to cease buying Russian oil and pivot towards US and potentially Venezuelan energy sources. This is a seismic shift in bilateral relations and represents a strategic realignment. For Indian exporters and IT companies, lower tariffs are a significant tailwind, explaining the strength we saw in ADRs overnight. Moving to Asian markets, which are painting a mixed picture this Tuesday morning. Japan's Nikkei 225 traded at 54,307, up 0.88% from the previous close. Hong Kong's Hang Seng stood at 26,981, barely changed with only 0.05% gain, while Shanghai's Composite declined 2.48% to 4,603. Japan's resilience is notable, with manufacturing expanding at its fastest pace in 3.5 years, according to recent PMI data. Now the all-important GIFT Nifty. The February contract is currently trading at 25,929, up a robust 3.19%. This is a significant move and tells us a very important story. What we're witnessing is aggressive short covering as traders scramble to buy back positions they sold during Sunday's budget-induced panic. Remember, the market absolutely tanked on Sunday when STT hikes were announced, with Nifty falling nearly 2%. That sharp sell-off created a glut of short positions and bearish bets from traders betting on further downside. Today's sharp rally is squeezing those shorts, forcing them to cover. Moreover, today is the first weekly expiry of February, which amplifies this dynamic. Weekly expiry days are typically volatile, with options traders managing large positions, and that's exactly what we're seeing in the GIFT Nifty rally. This momentum could carry through the day, but it's crucial to understand that much of this strength is mechanical short covering rather than fresh fundamental buying. From a technical perspective, today's action is being driven almost entirely by short covering. The GIFT Nifty's 3.19% jump overnight suggests that traders are aggressively unwinding bearish positions. Weekly expiry typically see elevated volatility in position squaring, but we're already seeing that intensity on Tuesday morning as options dealers neutralize gamma exposure and manage large outstanding positions. Keep an eye on how Nifty sustains above the 25,900 level. If short covering continues unabated, we could see a test towards 26,000. However, once shorts have sufficiently covered, expect volatility to normalize and potentially give back some of these gains. Bank Nifty will likely follow a similar pattern with elevated activity around contract expiry. On the commodities front, movements remain notable. Gold prices surged 3.93% to $4,842 per ounce, reflecting broader safe haven demand. Silver experienced an even sharper jump, climbing 7.21% to $84.99 per ounce. Crude oil, however, retreated slightly, down 0.03% to $62.34 per barrel, as easing Middle East tensions under Trump's diplomacy are reducing the geopolitical premium. Natural gas declined 0.48%. The gold and silver rally reflects lingering uncertainty about the rupee and global monetary policy, so that's a trend worth watching. For traders and investors navigating today's session, the critical distinction is understanding that today's strength is predominantly driven by short covering on weekly expiry. This is mechanical, not necessarily reflective of renewed investor confidence. The GIFT Nifty's jump is impressive on paper, but don't get lulled into thinking the structural concerns from the budget have disappeared. The STT hike remains a headwind for derivatives trading and FII participation. If you're a trader, use this rally to reassess your positions. If shorts have already been covered aggressively, the juice may be coming out of the move. If you're an investor, today's bounce provides a better exit opportunity if you're worried about the budget impact. The RBI monetary policy decision is coming up on February 6th, and that could be another inflection point, so remain cautious about using today's strength to add long positions aggressively. Remember, we're in a consolidation phase after a significant shock, and patience often beats aggression in such markets. Stay tuned for our evening market wrap, and please send in your questions about today's moves and how the trade deal is reshaping market sentiment. Subscribe to this podcast to hear US every weekday morning at 8. Thank you for joining me on What Will Move the Market. See you this evening.